Hello and welcome to the Luna Quarterly Update. My name is Alex Brandreth, Chief Investment Officer at Luna. It's certainly been an interesting quarter. It doesn't feel like it was 3 months ago, but as we started the quarter, we got a new Labour government. We've seen a change in the US presidential candidates with Joe Biden dropping out and Kamala Harris stepping in. We've seen tensions mount in the Middle East. We've seen inflation back down to the Bank of England's target at 2%. And we've seen our first interest rate cut in both the UK and US over the last few months. So I'm just going to go through all of those points today, and we'll also take a look at the performance of major markets over the last quarter. I'll just share this. So let's start with the bond market. It's been a strong period over the last quarter for bond investors. This chart has government bonds, gilts in blue, corporate bonds in maroon, strategic bonds, which are funds that can invest across different types of bonds, and emerging market debt in green. And as you can see, investors in bonds have delivered pretty solid returns over the last quarter. Just under 2.5% in government bonds, slightly better in strategic and emerging market debt. Now that's been supported by inflation coming down and interest rates being cut. What about the equity market though? It's been a little bit more mixed in the equity market. The US S&P 500 was slightly down by 0.2% during the quarter. Closer to home, the FTSE All-Share in maroon was up 2.26%. Pretty much in line with the Japanese market, although you can see that the yellow line has been a lot more volatile. The Japanese central bank increased interest rates during the period, and that unwound to a certain extent a little bit of the carry trade that was going on with the Japanese yen, and that caused volatility for the Nikkei 225. Europe was barely positive. Europe's been struggling economically wise because of electric vehicles in China, and manufacturing's really down. So European equities were slightly positive. Technology, the Nasdaq was a bit weaker during the quarter. A lot of the valuations come through and performance has come through over the last 2 years, and it gave some of those returns back more recently. But the standout return there is the Hang Seng, which was up 15%. And as you can see, it was pretty much all in the last week. I'm speaking now at the beginning of October, and the Chinese stock market is up 25% over the last 2 weeks. And that's because of stimulus measures that have been announced by the Chinese government and the Chinese central bank. The Chinese central bank have cut interest rates and the deposits required for second homes. And the Chinese government are also introducing stimulus measures to buy the equity market, which has been supportive of the equity market over the last quarter. And it's probably important just to reflect on a year ago, we were sat here, inflation was running at 7%. There was concerns about economic growth globally. Interest rates looked like they were going to stay high for a long time. And investors were nervous a year or so ago, and you were getting high returns in cash. You fast forward a year and markets have performed very strongly, both bonds and equities. Well, what's going on with the economy? If you go, this chart on the left-hand side go back to 2012, and we show this most quarters, and you can see growth was nice and steady up until 2020, and then you had a heart attack when we entered COVID restrictions. The economy bounced back quickly as the economy reopened, and economic growth more recently has been pretty positive. Some strong numbers out recently. The Labour government, I think, is actually going to be has been a positive in terms of there's a bit more stability within the UK, and the UK can be seen a bit more positive on a global scene. But more recently, there's definitely been a bit of a budget overhang. The budget is definitely causing concerns with some investors and businesses, and you've seen consumer confidence and business confidence drop over the last month as a reflection of just not being sure on what direction the budget's going to go. Now, as I touched on most times, GDP data always comes out with a bit of a lag. So what we look at on the right-hand side is the Purchasing Manager Indices, and these give surveys of what's going on right now within the economy. And this is done by S&P, and you can see here that a reading above 50 means expansion, a reading below 50 means contraction. So you want to be above the 50 line. In the UK, we're a service-led economy, so the services part of the purple line matters probably more than manufacturing. Not saying manufacturing is not important, but most of GDP is contributed from services. And you can see there that both lines have been above 50 in expansion mode now through most of this year, and if anything, have been accelerating this year as well. So the good news is the data right now on the ground is pretty positive for the UK economy. Inflation. Inflation's been the key topic that we've been talking about through the last 3 years, and it was predominantly driven by Russia's invasion in Ukraine, the subsequent impact that had on commodity prices. You can see the grey bars there, which were very positive, which is electricity and gas. More recently, as you look at the end of that, towards the end of that chart, you can see those bars have been negative. So electricity and gas has been deflationary. That's because electricity and gas prices have fallen year on year. As we get through towards the end of this year and into the winter, we're expecting those grey bars to start to be slight positives again, because electricity and gas prices have increased now over the last year. The blue bar, core services, has been pretty sticky, and I think that's causing a little bit of concern at the Bank of England that it hasn't been coming down. Services are very much linked to wages, and wages have been quite sticky, and wage inflation has still been quite high. But the good news is that all the other bars, so the green, which is core goods, food and alcohol, have all started to be less inflationary than they have been, and that's why we're now at an inflation level in the UK consumer price index of 2.2%, which is very close to the Bank of England's 2% target. As I said, looking forward towards the end of this year, we are expecting inflation to continue to creep up a little bit, maybe to 2.5–3% area, but importantly, not going back to the high levels that we saw. The big unknown, and I touched upon it earlier, is the issues with the Middle East. As we've seen with Russia invading Ukraine, when you have wars, they are inflationary, commodity prices increase, and we have seen an increase in the oil price more recently. The oil price has ticked up from $70 to $80, so it's increased by about 15%. Now, crucially, it's nowhere near the $130 that it got to in the middle of when Russia invaded the Ukraine, but it can definitely creep up if things continue to escalate in the Middle East, and that's very much on our mind. But as you can see, when oil was at those levels in 2022, liquid fuels was adding about 1% to inflation. So it's nowhere near going to have the same impact that we saw in 2022, but it's definitely something that we are monitoring and need to be mindful of. And not just us, the Bank of England need to be mindful of it as well. This chart shows the direction of interest rates since 2002 to where we are. We go through that 2002 to 2007 period when interest rates, would I say, were in a more normal range. The last 15 years has been very abnormal in that we've had ultra low interest rates for a long period of time. And that makes people make bad decisions. People think that money's free, they leverage up, they take on too much debt. And that's fine when interest rates are low, but what we saw in 2022 is interest rates increasing significantly, and therefore the cost of debt increasing, and that's definitely causing some issues still with UK public finances. But the good news is inflation's back down to the Bank of England target, and the direction of travel is definitely going lower. So we'd expect to see an interest rate cut in November. And the market is expecting that the new neutral rate for interest rates is around 3.5%. So we're at 5 today. We've got 1.5% to come. The market is expecting that this is done on a quarterly basis over the next 18 months or so. I think that's probably a little bit too simplistic. Nothing's ever easy like that, but we're expecting interest rates to come lower over the coming months and years. Thank you for listening today. If you do have any questions on your Luna portfolio or would like to be in touch to learn anything more, please don't hesitate to be in touch. Thank you for your time.